Listen, if you've been checking your portfolio lately and feeling that rising sense of panic about the recent drop in precious metals, I want you to just take a deep breath. Welcome to The Explainer. Today, we're going to break down exactly why everything you think you know about this current correction might be completely wrong. In fact, we're going to look at why gold and silver's next rally could be genuinely historic.
It is totally, perfectly natural to feel a deep, unsettling dread right now. Watching an asset you hold retreat this fiercely, it feels like a gut punch. A lot of retail investors are experiencing profound anxiety just watching the headlines scream and feeling this overwhelming urge to hit the panic button. But I'm going to challenge you to step away from all that noise. We are not going to rely on 50 minutes of frantic, hyperventilating financial television. Instead, we're relying on 50 years of cold, hard data.
Okay, here's our roadmap for today. We'll start with the anatomy of a correction, explore history's accurate playbooks, look at the new structural drivers, dive into silver's explosive setup, and finish up with timelines and targets.
Let's jump right into Section 1, Anatomy of a Correction. We really need to strip away the raw emotion here and replace it with empirical facts. Because right now, all that fear you're feeling, it's a reaction to one isolated number, 27%. That is the magnitude of the recent drop from that staggering January 2026 high of $5,595 an ounce. And yeah, that number feels heavy. It feels like a definitive end to the run. But let's completely flip that narrative right now, because in market history, context is literally everything. When you take that current 27% drop over 5 months and you compare it to the historical average for a secular gold bull market, well, historically, we see a 23 to 30% drop over 5 to 7 months. So a totally different picture emerges, right? Our current situation falls perfectly, squarely, right in the middle of that historical cluster. This magnitude and duration, it is absolutely not a crisis. It's a textbook reset happening right in the middle of a standard, secular bull market.
Moving on to Section 2, History's Accurate Playbooks.
So if we know we're in a normal reset, the next step is looking at historical analogs so we can separate the terrifying myths from the highly probable realities. And we have to thoroughly dismantle the myth that's haunting all the forums right now. People keep whispering about the 1975 collapse, that terrifying 47% crater. But you have to consider the massive difference in the macro environment. Back in 1975, gold had gone completely parabolic because the stock market had just endured a devastating 50% crash. Capital flooded out of equities in a total panic. Today, we're seeing gradual, massive institutional accumulation without any major equity capitulation yet. It's apples and oranges. Those 1975 conditions simply do not exist today.
Instead, we need to look at 1973. The astonishing precision of this historical playbook is wild. The 1973 correction saw a 28% decline right before a massive, explosive leg higher. And our current correction? 27%. It is nearly an identical twin to that historical template. If you have the discipline to follow 50 years of chart data, you quickly realize the playbook has already been written.
Let's look at Section 3, the new structural drivers.
We've got the technical chart patterns down, but let's shift focus to the unprecedented fundamental realities actually powering this cycle behind the scenes. Think about these undeniable facts. Central banks are currently buying at more than double their pre-2022 pace. The People's Bank of China is locked into strategic accumulation. In 2025 alone, ETF inflows hit a record $89 billion. And underneath all of that, you have intensifying fiat debasement and massive sovereign debt. This absolutely proves this isn't just retail day traders speculating. We are talking about sovereign wealth and institutional capital flows preparing for a seismic structural shift.
And the crucial takeaway is right here in this price target, $4,900 to $5,300. This isn't some wild guess from a Permable newsletter, okay? These are public forecasts for late 2026 coming from highly risk-conscious institutions like Goldman Sachs, JP Morgan, and Bank of America. When the most conservative, stuffy financial institutions in the world are lining up behind gold's continued ascent with numbers like these, well, that demands our attention.
Section 4, Silver's Explosive Setup. We absolutely have to pivot to silver, because in this bull market framework, silver is the wild child. It's the more volatile instrument and a much more emotionally charged story. We are staring down a massive structural deficit right now. Silver sits at this crazy, powerful intersection of monetary debasement on one side and soaring industrial demand on the other. Based on the data, we're looking at a multi-year structural deficit where demand exceeded mine supply by roughly 160 to 200 million ounces in 2025 alone. To put it mildly, that is a profound gap.
And what guarantees this deficit will dramatically resolve in price? Well, it's not just folks buying jewelry and coins. It is massive solar deployment and the relentless, power-hungry build-out of AI infrastructure. Turns out artificial intelligence has a very real, insatiable appetite for physical silver. A supply deficit of this magnitude, stretched over multiple years under this kind of industrial strain, it simply doesn't resolve quietly. It resolves explosively.
Which brings us to the magic number, $70. Now here is the secret insight that so many retail investors miss entirely. Silver does not need to shoot straight up to $120 right away to make a fortune. Once silver firmly establishes this $70 level as a structural floor, proving the bull market is intact, the mining stocks are going to act as leveraged plays and move violently. The stocks are going to tell a story well before the metal hits its ultimate peak.
And finally, Section 5, Timelines and Targets.
We've seen the history, the fundamentals, and setup. Now let's answer the most important question every investor has. Exactly how long do you have to hold this conviction until the market actually validates it? I want you to just stop, take a breath, and absorb this anchor thesis. Those corrections were part of the bull market, not the end of it. Seriously, if you remember only one thing from this explainer when market doubt creeps in, let it be this phrase. It's your ultimate foundation for surviving volatility.
Based on 50 years of data, we essentially have two historically grounded scenarios to watch. The aggressive case maps directly to that 1973 breakout, putting us at new highs in under 18 months from the January 2026 peak. Now the conservative case, drawing on the 2008 financial crisis, points to 18 to 24 months. But notice the big picture here. Even in the frustrating, delayed, worst-case scenario, these metals are still hitting completely new highs shortly. You aren't waiting a decade for this to play out. You're waiting months.
Let's pull this all together and see how the next few years build out. On the aggressive track, gold hits $6,000 by October 2026. If it's delayed, we see new highs by mid-2027. But look out at that final 2028 to 2029 window. When the broader equity rotation finally happens, macroeconomic strategist Tom Bradshaw projects some shocking but mathematically sound targets. Silver reaching $375 and gold hitting $9,000. Those aren't just numbers. Those are the destinations of a generational shift in capital.
So armed with 50 years of empirical data instead of emotional reactions, I want to leave you with a question to really think about. Which scenario do you find more compelling? The 1973 fast recovery or the 2008 extended timeline? Either way, you now have the analytical framework to view this correction not as a reason to panic, but as a massive historic opportunity. Thanks for diving into the data with me today. Keep this playbook handy as we navigate the months ahead.